Standard financial advice points toward buying a broad index like VOO or a dividend ETF like SCHD and holding for decades. On paper, it's a highly successful way to build a massive net worth over time. For investors approaching retirement, however, a high account balance matters less than the amount of cash actually hitting their bank account every month. Standard funds often struggle to bridge this gap. VOO yields around 1.5%, and SCHD sits near 3.5%. Generating a meaningful, livable income from yields that low requires a massive amount of capital. Compare the monthly cash flow on a $500,000 portfolio. VOO pays about $625 a month. SCHD bumps that to $1,458, but a 7.3% yield fund produces over $3,000. The trade-off? Massive cash flow today requires sacrificing the steady upward growth of standard index funds. Investment success requires matching the utility of your money to your current stage of life. To solve that immediate cash flow problem, a quiet subset of investors eventually shifts their attention toward a category of funds designed to yield double or triple what standard ETFs pay. These are called closed-end funds, or CEFs. Unlike an ETF, which constantly creates and destroys shares based on demand, a closed-end fund launches with a fixed amount of capital. Once those shares are created, they trade on the open market like a regular stock. Because the share count is fixed, you get a unique structural quirk. The share price often floats disconnected from the net asset value, the actual worth of the underlying assets. This means investors buy the fund at a premium or at a discount. That structure allows some of these funds to maintain payouts straight through recessions, but using them safely requires learning a specific set of rules before you buy in. The first trap is jumping straight at the highest number you see. It is easy to find funds advertising yields of 13% to 16%, but buying based on the percentage alone is a major risk. Initially, the strategy feels bulletproof. The massive payouts show up in your account every month like clockwork, creating a strong sense of security. Then the math catches up. If the underlying investments fail to generate enough real money to support that yield, the fund is eventually forced to quietly cut its distribution. This chart shows the market reaction. When the payout is cut, yield chasers panic. The share price plummets. To maintain high yields before that cut, some funds use destructive return of capital. This hollows out the foundation, simply handing you back your original investment. Pulling in $1,000 a month does you no good if your original investment principal is rapidly decaying in the background. Consistent cash flow is often mistaken for safety. You have to understand the internal structure before you trust the yield. In contrast to those volatile high-yield traps, the DNP Select Income Fund is built intentionally around low-growth, predictable assets. The portfolio consists of electricity, gas, water, and infrastructure. These are essential services that people pay for regardless of the broader economic environment. In 2020, even when major cities went dark and global commerce shut down, the power grid stayed on. People continued to pay their utility bills. That resilience has allowed DNP to pay a reliable yield of around 7.3% every single month since 1997 without interruption. The trade-off is simple. In exchange for nearly 3 decades of unbreakable cash flow, you accept that your initial investment will see almost zero long-term capital appreciation. However, long-term DNP shareholders can capitalize on a little-known compounding edge called a DRIP discount. This flowchart breaks down the mechanics. When trading at a premium, the DRIP plan routes your dividend reinvestment roughly 5% below the market rate. Instead of buying shares at $10.50, you acquire them closer to $9.97. Capitalizing on this requires work. Not every brokerage supports it automatically, so you must call your broker and confirm your account is set up for discounted reinvestment. On our risk matrix, DNP maps right here. It intentionally trades excitement for predictable bill-paying power. Investors who want utility exposure but can accept a lower starting yield often look to the Reeves Utility Income Fund, ticker UTG. As the chart updates, UTG plots slightly lower on the yield axis. However, it offers a proven history of growing its monthly distribution over time, benefiting those who can wait for that payout to compound. On the opposite end of the spectrum, PIMCO operates funds like PTY and PDI for investors demanding aggressive yields of 10% to 11%. These aren't built on stable physical utilities. PTY and PDI consist of complex credit markets, holding corporate bonds and mortgage-backed securities. To reach those double-digit payouts, these funds use leverage, borrowing money to amplify the returns of lower-yielding assets. Like a pressure gauge redlining, that structure is highly sensitive. Rapid rate hikes or credit stress can cause massive price volatility and squeeze performance. These funds have survived difficult cycles, largely because of PIMCO's experience in managing complex credit markets. This final update to the chart shows the reality of the trade-off. Pushing past 7% yield moves you into the top right corner, trading away predictability for intense complexity. The correct choice depends entirely on matching the fund's profile to your current life stage. If you are an accumulator focused on maximizing net worth for the future, stick with the growth of VOO or SCHD and ignore current cash flow. If you are a predictable payout seeker who needs stress-free cash flow to cover basic bills, build your foundation on DNP. If you are a yield maximizer with strong emotional discipline, you can allocate risk capital to the higher payouts of PTY or PDI. This decision matrix lays it out clearly. Accumulators align with growth ETFs, payout seekers with stable utilities, and yield maximizers with leveraged credit. Mature investors rarely limit themselves to one category. They often mix these tools to create a custom utility machine. Use DNP for essential bills, PTY for aggressive bonus income, and SCHD for long-term growth. Focus on building a portfolio that produces the exact financial utility you need right now, rather than obsessing over the largest possible paper balance.